Conversation with Lou Piantadosi, Eaton Vance Management Vice President and Co-Director of Growth Equity, joins us this morning. Lou, it's a good day to have you. Thank you for the time.
Good morning, Carl. Thanks for having me.
I was just looking at a note here from Morgan Stanley. They say that their unprofitable tech basket, and everybody's sort of got a version of that, has underperformed SPX by 42% over 3 months. And if you take out COVID last spring, it's the worst stretch in 10 years for any thematic basket, and they looked at over 100. I guess at this point, do you think that's getting a little tired?
I think that the sell-off is justified, given the meteoric rise that a lot of these stocks exhibited, particularly post the COVID, initial stages of COVID. And, given where we are right now, I mean, there's four real headwinds to most areas of tech, and namely the fear of higher rates, tougher comparisons going forward, particularly to those that have benefited from COVID, corporate tax reform, which is something that isn't being discussed right now, but it will have an impact on tech more so than other areas of the market. And then lastly, particularly for mega cap tech, I think we're seeing more and more antitrust headwinds starting to pick up as well. So all of those headwinds, kind of come together at a time when there's other areas of the market that will benefit from a recovering economy that had been neglected by the market for the last few years. And now we're starting to see a real resurgence. So really no surprise here.
It does sound like you think there are areas within tech that are buyable on a pullback. And I think you're pointing to semis on that. Versus others like payments and cloud, where maybe the high valuation means there is a little more downside to come.
Yeah, I think that's exactly right. I think the semis are buyable right now. I think the stocks have come in, not as much as some of the others, but the valuation of those companies are much more attractive for kind of a good entry point in some of those names. I like the analog semis the best because they do have leverage to a recovery of the industrial economy. Areas like payments, AI, the cloud, still great long-term secular growth opportunities. But I don't think those names truly bottom out until investors can kind of figure out, well, where are rates going? Where is this inflationary environment we're in? Is that transitory, or is it going to be something that's longer lasting? And if it is in fact transitory and, rates go to, 10-year goes to 2% and change, those stocks will be, close to bottoming out here. But if it's something more difficult than that, then we might have a little bit more to go before those do bottom out.
Lou, it's Morgan. Just in terms of being able to gauge a bottom, or I guess factor in some of the signals that might indicate we're there, is this just a matter of giving time when you talk about the possible transitory nature of the situation, or are there certain actual things that you're looking for right now?
Yeah, I think for us, the biggest things on a fundamental basis is we're likely to see a real deceleration of growth in a lot of those names, particularly the ones that did benefit from the COVID shutdown. And, in the growth stock world, nobody likes to see a deceleration. But given that, we had kind of where we borrowed some business from the future because of COVID, we're going to see that natural deceleration. But the market still hasn't really come to grips with how much of a deceleration are we going to see. So I think once the bar gets reset, and I think it's coming in the next quarter or two, we'll get a better picture of what is truly the long-term sustainable growth rate for these names. And once the market gets comfortable with that, these names probably become investable again.
Shepard Smith here. Thanks for watching CNBC on YouTube.